Hi, dreamers. I do a full portfolio review only 4 times a year or once a quarter. So now is the magic time, and there's some interesting updates as I've been doing the following things. Adding in that cash layer I've talked about to pad my paddy, diversifying even more into some ETFs, carving out some cash for that new strategy I talked about with the put options, and finally rotating into positions that favor macro conditions. So it's gonna be action-packed. Are you ready? Here we go. Okay guys, so here we are in my spreadsheet, and just to orient you quickly, I've got the symbol, the description, the quantity of shares that I have, the last stock price, the current total value that I have in my portfolio, the next or most recent X date, the amount per share, the next or most recent pay date, the current dividend yield, my total dividend annual income based on how many shares I have, the sector, geography, and then these last sections are ones that are really valuable. Whether or not this stock is a dividend king, which means it's been paying out and increasing dividends for over 50 years, whether they're a dividend aristocrat, which means they've been paying or increasing for the last 25 years at least, or if they're a dividend contender, and that means paying out or increasing between 24 and 10 years. Then the last two columns are whether or not they're a Canadian dividend aristocrat or a UK dividend king. And something new that I added for this time is the beta, or measure of volatility, for each stock. And at the end, I'll reveal what my portfolio's weighted beta is. So how volatile is it? And that'll be something new for you to look at. And then at the end, I'll show you at the top level how diversified this portfolio is across geography and sector, so you can compare it in your mind to your own. Okay, well let's get started. So my number one position is Mo Altria. I've got just over 3,000 shares, $140,000 worth, and it pays me $11,635. And of course, Mo is a dividend king. Now, one of the things you'll notice is that I actually took down Mo just a little tiny bit. And this is something I've been talking about for a while. Even though I'm comfortable with Mo and not concerned that they're going to stop or cut the dividend anytime soon, I am conscious of the overall industry. And you'll notice as we go through that I also have a lot of BTI. And so I'm conscious of how much I have in one particular industry. And that's something that over time I'll be decreasing just from a risk perspective. But for now, I have no concerns about Mo. My second biggest holding is BCE, which if you're not familiar is the Canadian telecom giant, kind of like in the US, the equivalent to T. Now, let me show you something. If you were to look at the last 10 years across AT&T, Verizon, or BCE, you can easily see that the total return for something like BCE is 82.88%, as compared to a negative 2.69% for AT&T. And only 10% for Verizon. So that's one of the reasons why I favor BCE as my main position for telecom space. So here we are with BCE. I've got almost 3,000 shares, 2,909 shares, or a total of $128,000 worth. And that kicks off $8,448 a year. And as you can see, it's a Canadian dividend aristocrat. My next biggest position is BTI, with 3,853 shares, and that generates $13,215. Now, BTI is a UK company, and so one of the things you have to be aware of when you buy BTI as a US investor is that it is subject to the currency exchange with the UK pound, and that sometimes affects the fluctuation of what your payout is every single time. But as you can see, BTI is a UK dividend king with a fantastic payout record. Okay, my next position is JEPQ. And of course, you know I have a video dedicated to the reasons why I picked JEPQ over JEPE. And if you know anything about JEPQ, you know that it's focused on the NASDAQ. And here's some of the holdings inside of JEPQ: Microsoft, Apple, Google, Amazon, Nvidia, Meta, Tesla, etc. And so with JEPQ, it is a derivative ETF, but it also gives really nice exposure to the NASDAQ and more tech stocks, which is something I wanted to increase. So right now I've got 2,030 shares, or just under $100,000, and that's generating $8,935 a year. and it pays out monthly, which is great. Now, one of the issues and things to know about JEPQ is that it changes every single month. So if you're buying into JEPI or JEPQ, just know that that's the case. It'll go up and down every single month, specifically because it's derivative and based on all of the options that they're writing for that particular month. Okay, my next biggest position is my favorite REIT, which is ticker symbol O Realty Income. I've got just over 1,200 shares, or $73,764 current value, and that kicks off about $3,718 a year. O, along with other REITs, has been really pushed down because of the interest rates, and I'm anticipating that REITs are going to have a really nice comeback as those interest rates stabilize and potentially even start to deflate over the next few years. And the other nice thing about O is that it's a dividend aristocrat with over 25 years of dividend increases. Just a solid stock and company. All right, my next position is IBM. I've got 446 shares, or $59,000 worth, and that kicks off almost $3,000. And IBM is a dividend contender with between 10 and 24 years of dividend increases. Now, IBM has been a little bit of a dog for a while, but it's something that I purchased actually pretty recently, and believe I'm watching a little bit of a turnaround. So I know they haven't materially increased their dividend lately, but it's a hold for me. All right, my next position that I've really loaded up on earlier this year in a dip is PTY. I've got almost 4,000 shares of PTY, and it's kicking off over $5,628 with that beautiful 10% yield. Yum. Now, one of the reasons why I've built up my position on PTY is another one of those macro rotation conditions. Because again, as I think about interest rates starting to normalize and maybe even deflate, that is good news for the bonds. All right, my next biggest position is Devo. And as you guys know, I love Devo. And I've been one of the first ones to be screaming from the rooftops about Devo. One of the things I like about it is just how concentrated the basket of holdings are. They have less than 40 holdings, and this is it right here. Microsoft, Visa, Procter & Gamble, McDonald's, J&J, UNH, JP Morgan, etc. And the managers of this account sell options around these particular holdings. The other thing I wanted to quickly point out is just the 1-year total return if you compare Devo to SCHD to JEPQ. And here you can see the nice almost 20% total return for JEPQ. But take a look at Devo. Devo is obviously not NASDAQ based, but over the past 12 months, it's handily beat even SCHD. So these are 3 of some of my favorite ETFs, and they're working in very different mechanical ways. So if you haven't looked into Devo and you're interested, I would encourage you to take a closer look. My next position is T. Right now I've got 2,900 shares of AT&T, and that's kicking off just over $3,200 every year. Now, I got a lot of flack when I sold off a big tranche of AT&T earlier this year. And the fact that they've got a huge amount of debt and may have to refinance that debt soon into even higher interest rates than they've had in the past, it really makes me think about taking some additional shares off the table, especially because my exposure to telecom is already pretty big enough, and I really do favor BCE the most. And then we've got BNS, Bank of Nova Scotia. I've got 772 shares of BNS, and at a 6.41 yield, you guys. 6.41 yield. That's kicking off just under $2,500. And BNS is a Canadian dividend aristocrat. Now, if you haven't looked into any of the Canadian banks as a US investor, I would encourage you to do so. It is a very stable industry in Canada, with a long history of payouts and increases back into the 1800s. And so guys, that's my top 10. And I've got quite a bit of diversity in there if you look at consumer staples, telecom, NASDAQ ETF, REIT, infotech, bonds, the banking industry. I've got US, Canadian, UK, just a ton of diversity just in the top 10. All right, let's go through the next 10 and then we'll kind of speed it up so I can show you the rest of the portfolio and how it looks overall. Okay, so let's go down to Pfizer. And this is really the first big healthcare stock that I have. I have over 1,000 shares of Pfizer at a current yield of 4.55, and it's kicking off just under $1,700 for me. I think Pfizer is a steal right now. But at over 1,000 shares, I'm personally not looking to add any more at this point. But Pfizer is a solid company that's obviously made a ton of money over the last couple of years with their COVID vaccine. And their pipeline is packed with other goodies. They're also a dividend contender. So that's Pfizer, my top healthcare stock. And my next holding is Avgo, and I really wish I would have stacked the bricks on Avgo way sooner, because I have just been adding 1 or 2 shares over time over the last couple of years. Well, I only have 41 shares of Avgo, which is about $36,000 worth. And as you probably know, Avgo just completely went bonkers recently and has continued to trend up. But man, when you zoom out and you look at the 10-year, just take a look at this stock. Beautiful, beautiful trending all the way up. So Avgo is, I gotta say, probably my favorite dividend growth stock. And it also is a dividend contender. I tell you what, it's hard to get any better than Avgo. All right, so my next stock is Philip Morris. I've got 354 shares there, kicking off $1,800, and it also is a dividend contender. And then I have AbbVie, 228 shares of AbbVie, and it brings me in about $1,300. My next position is MFC, and I've got over 1,500 shares there. The current yield here is 5.82, and it's bringing in just under $1,700 a year. And MFC is a Canadian dividend aristocrat. Now here's my biggest position in the utility space, Duke Energy. 314 shares there, kicking out just under $1,300. Now STAG is a REIT that I've been building up lately, as I think about trying to take advantage of those macro conditions where REITs are going to be bouncing back. And STAG is a great commercial REIT with big warehouses. I've got just over 700 shares with STAG, and it's got a 3.89 yield right now, and is also a dividend contender. Now, Ben is one that I've held for quite a long time, and with just over 900 shares, it's generating about $1,000 for me, and it's also a dividend aristocrat. Next, I've got STWD, which is also a commercial REIT, at just under 1,200 shares. It's got a beautiful 9.3% yield right now, and it generates $2,270. Then we've got Verizon, which I showed you a second ago in the graph with BCE&T. Really hasn't performed very well, and it's something I'm reconsidering. But for right now, I've got 700 shares, and at a 7.5% yield, it's generating about $1,800 for me. The next position I have is BDJ, with just over 2,500 shares there, and it's generating almost $1,750. So this is one that I use to generate cash to put into other dividend growth stocks. And now we move on to WPC. WPC is a position I've been growing lately, and I've been adding quite a bit. This is one of those REITs that I feel like is a forever REIT, and at an over 6% yield, I've been adding. So I'm up to 266 shares, $18,000 worth, and it's generating $1,100 right now. And it's also a dividend contender. Now the next stock I did an entire video about, and it's one of those ones I rotated into pretty heavily to take advantage of that macro trend. Because there was a little bit of a bank panic earlier in the year, if you remember. Gosh, some people don't even remember that now. But Truist is such a strong company. And if you want to learn more, I'd recommend you take a look at that video. And even though it's not a dividend king, aristocrat, or contender, it's actually on its way to becoming a contender with 8 years of dividend payout and increases. So I've got just under 550 shares, generating over $1,000 for me. And next we have SCHD, which is kind of everyone's favorite. I've got 232 shares, generating just over $600, and it's a dividend contender. I really like SCHD as a long-term play, but I'm not over the top like some people are. And it's definitely not something I'm going to put all my eggs in, but I do like having it in my mix. All right, next we have BST, which is really hitting 2 of my plays. It's acting as a cash layer for me, but also rotating into those macro trends as it's taking advantage of the science and technology boom. I've got 486 shares there, and at an 8.69 yield, it's generating just over $1,500 for me. All right, my next position is Fortis, which I also did a dedicated video on. It's just a solid long-term play. With 373 shares, it's a utility company in Canada, and it's generating just over $600. And of course, is a Canadian aristocrat. All right, Now, I don't know if IIPR is everyone's favorite or everyone's favorite to hate, but I continue to hold my 200 shares of IIPR, and I do think that it's going to rebound at some point. It's currently at just under a 9.5% yield, and this REIT generates just under $1,500 a year for me. All right, we move on to Pepsi. And in the Coke versus Pepsi challenge, from a stock perspective, I choose Pepsi all day long. Just take a look at this analysis I generated in Seeking Alpha. Over the last 10 years, total return for Pepsi has been almost 190%, as compared to Coca-Cola's 100%. And if you move that out to the maximum, since 1993, Pepsi is closer to 2,000%, as compared to Coke's 1,000%. So hey, a 1,000% return ain't bad, but you know what I prefer? 2,000%. So yeah, I love Pepsi, and this is one I've actually added to quite a bit over the last few months. As I start to rotate and take the cash from my top positions and put them into dividend growth stocks like Pepsi. Then I'll cover a couple more just to show you my top 30. So BMO is another bank in the Canadian financial space. I'm up to 163 shares, and it's generating just over $725 for me. And of course, it's a Canadian aristocrat and has been paying out steadily since the 1800s, guys. Come on, this kind of stuff is a no-brainer. And the last one to round out my top 30 is CFG at just under 500 shares, kicking off $830. And that right there wraps up my top 30, 21 of which are a dividend aristocrat of some kind, keeping in mind that ETFs don't qualify for that distinction. Alright, so now I'm going to speed this up just a little bit so you can see the rest of my portfolio. And what you're going to see more in here is quite a bit of dividend growth stocks with lower yields that I'm building up over time, and some of which are positions that I rotated out of that I'm now building back. Alright, so here we have MetLife, over 200 shares here, kicking off just over $400. And then I have QQQX, which is another dynamic ETF, 470 shares here, kicking off just under $800. Now, Prudential is a company I feel like has been unfairly dragged down by the other financial panic. So I've been adding some shares to Prudential a little bit here and there recently. I've got 125 shares now, and it kicks off $625. Texas Instruments is one of those that I just love. It's a fantastic long-term play. So I build it up a share at a time here and there whenever I can. But unfortunately, I hold it in an account where I don't have a lot of spare cash. So I'm up to 62 shares, and it generates about $300. But really, this one's more about the growth. Now, JHG is a UK company, and I've got 385 shares here, kicking off about $600. And no one ever talks about JHG, but it's actually performed quite well for me. BMY is one of those companies that I feel like is really low right now. And so I just recently added about 100 shares of BMY, which I also use for calls and puts. So I've got about 10,000 shares of BMY, and it generates $372, and is a dividend contender, by the way. SLF is a Canadian financial company that I've got 185 shares of, and it generates just over $400. It is also a Canadian dividend aristocrat. Now, PSA, I think, is a REIT that's a bit of a value right now. I've got 29 shares of it, and it's at a 4% yield. Not bad. And then, of course, we have Microsoft. I was building up Microsoft quite a bit over the last few years, but then rotated some of that stock out before the big dip. And after that dip, when it was in the 200s, I quickly bought back about 20 shares. And so, I mean, Microsoft is probably the most solid company out there, and I'll just be building back over time. Then we have Canadian Imperial with 148 shares there, which is another one of the big six Canadian banks. And then we have a rare diamond, FRT. It's rare in that it's the only REIT that's a dividend king, with over 50 years of paying and increasing. So I've been adding to that slowly over time as well, and up to 60 shares. Then I've got GSK, which is a healthcare company in the UK that used to be a UK dividend king, and cut their dividend for the first time in a long time fairly recently, but are now in a better place financially. Now, you're probably picking up a little bit of a pattern, because one of the rotations I've done based on macro trends is rotating a little bit harder into the REIT space or real estate. as I think REITs are going to rebound pretty well over the next few years. So Getty is one that I've been adding to quite a bit over the last few months. And now I'm up to 144 shares there. And it's still at a great 5.20 yield. So I think we're going to have a nice return on Getty. And already have. And of course, EBF is another one that nobody ever talks about. Maybe I'm the only one that owns. But it's done pretty well for me. 227 shares there, kicking off about $227. And then we've got Procter & Gamble, which is a dividend king, with about 30 shares there and just under $5,000 worth. Sunoco is one of my rare oil stocks. I've got 100 shares there that I also use to sell options on. And right now it's at a 7.5% yield. Old Republic is my next one, 160 shares there, which is one of those boring insurance dividend aristocrats that nobody talks about, steadily growing. And then we've got UPS, just a small position here, just under $3,000. Hollis is my next position, which is another Canadian telecom, just under $3,000 there. And McKesson is one of those stocks that is an unbelievable growth stock that I've been trying to add to over time. It's just over $400 a share, so I've only got about 7 shares, and it only generates about $15. But again, this one is more of a dividend growth play for me, as is Cardinal Health, or CAH. I've got 27 shares there. So we've got a cluster here of some healthcare stocks, also with UNH, which has had a little bit of a dip lately and might be something that I try to buy a few of over the next few weeks. Only 5 shares there, worth about $2,500. I've got Mondelez next, with 31 shares here, kicking off about $48. And then we've got Abbott Labs, which generates about $42 for me and is a dividend king. I finally broke down and started putting money into Maine. So I've got about 52 shares here, and this is one I'm going to be trying to build up so that it can take advantage of the financial recovery. So this is another one of those rotations into the macro trend. You know, there's some controversy on Cisco. Some say it's a dog and some say it's going to be a sleeper hit. But for me, it's a hold for now as a dividend contender, and it generates about $65. And I've got about $2,000 there. This is another controversial take. I don't have a ton of Apple stock. I have just enough to keep my finger in the water. I think Apple is an incredible company and undoubtedly has an amazing moat and has generated incredible returns in the past. But since I'm at the point in my life where I'm looking for cash flow, it hasn't been a main priority of mine. And the question is, what is the growth going to look like over the next 10 to 20 years? So I think it'll always be a smaller position for me, but probably won't become my number one position anytime soon. All right, PLD is another relatively new position, and again, it's me trying to take advantage of rebound. Now, utilities have been hit a little bit hard, and you may notice that I took Southern Company down quite a bit. And it's not because I don't think it's a great company with a huge moat that will last forever. I do. I purely have been looking at short-term opportunities and where I can rotate out a little bit to generate more cash flow and free up some cash. And this was just one of those areas that I identified. All right, so to round out my entire portfolio, I've got about $1,500 in Nextra Energy, $1,500 in APLE, a hospitality REIT, ripe for rebound. I've got about $1,500 in Cintas, which is a dividend growth stock for me, $1,200 in GPC, a new position in MCN, and about $1,000 in NEP, which I simply bought because my friend Jeremy bought it, and I wanted to start to monitor this company. I've got a new position in Cube of just about $1,000, and whenever you see me at about $1,000, you know that I'm starting a position and monitoring this stock. I've had about $1,000 in BBN for a long time because it served as my canary in the coal mine for bonds, which I now think is starting to experience its day in the sun. I've got about $1,000 in ADP, and same with PFG, Qualcomm. What's up with this tiny amount of Chevron? Well, the reason for that is I've held Chevron for a while and actually sold a ton of it when it was about $180, $190 a share. And so right now I'm just holding my one share and trying to figure out if I want to add some back or maybe just do some puts. I'm not a huge fan of the oil and gas industry. It's just not my passion. So for now, I'm just hanging on to that one last share. And then, hello, what am I doing here? Well, this is me doing an experiment. You probably have heard about those yield max, insane yield ETFs. 47%, 34%, 73%. What is going on here? And so, one of the things I like to do instead of just sit on the sidelines and speculate is go ahead and buy one share. It's not going to kill me to hold a $17 share or a $16 share in order to get myself in the game. Because once it's in my portfolio, all of the news and the alerts and all of those types of things start to stream in. And I just generally pay more attention when I actually have skin in the game of any kind. So that's what you're seeing me doing here, is just starting to do research. And then take a look at this. I actually have about $100,000 just sitting here in cash. And that's evidence of the other strategy that I announced in a recent video, which is freeing up some cash in order to do more puts in particular, and taking advantage of that double dip strategy that I laid out in detail. So if you haven't checked that out, you really should. So what's my total patty, given that I've taken out over $100,000? It's really not that different. $94,481, which is pretty darn close to the $95,786 that I reported out in March. So I'm doing something right with my cash layers and my diversification in order to keep my patty pretty steady. I've got a 6% yield on this portfolio. And of course, this is a snapshot, but right now it's 1.559,225. with over 38,500 shares of different stocks. And again, you can kind of see how my patty has grown from September 2022 at 81,000 and December at 83,000 to that moment in time where I was really pushing it in March at 95,786. And now here we are at 94,482 with $100,000 in liquid cash in order to really leverage for those put options. And so how does this look across geography? Well, this really hasn't changed much at all. I'm about 70% US, 17% Canadian, 2% international, which is pretty much Philip Morris, and then 10% UK, which is pretty much BTI. And as we go into the sectors, I've got 22% consumer staple, which, let's be honest, it's pretty much sin, and 14% telecom or communication services. These are two areas that have actually decreased a little bit. For example, my consumer staples used to be about 25%. And where has that shifted? Well, it's shifted into ETFs. A big part of that is JEPQ, taking advantage of the NASDAQ rebound, and also shifting into financials to take advantage of the financial rebound. And it's also shifted into real estate to take advantage of the upcoming rebound there. The other couple things you'll note for me is just really low on oil and gas. And for me, again, it's just not my passion, not where I want to do research, and super low on consumer discretionary. What in the world is this 0.1%? Well, believe it or not, GPC is categorized as consumer discretionary, which I gotta be honest, I kind of disagree that automotive and industrial parts are discretionary. If your truck breaks down, I'm pretty sure you're gonna fix it. And I'm also trying to rotate into more dividend growth healthcare stocks like McKesson and UNH. But in general, in terms of my sector rules, I really don't want any one sector to be more than about 20%. And I try to take a look at this pie as I think about the macro trends that I want to roll into versus retract. And that's the total of where I'm at, guys. But I want to leave you with this one idea. Every time I look at my portfolio, I just fall in love with it all over again because it's generating so much cash. In addition to now me building back some growth. And it's so well diversified across geography and sector. In addition to being heavily populated with all of these dividend kings and aristocrats. In fact, 45 of the about 70 stocks that I have are a dividend king aristocrat contender in the US, Canada, or UK. And let me show you the last stat that's the new one that I added to this spreadsheet, and it's beta. And here you can see the beta of all of the stocks in my portfolio, which is again a measure of volatility. And so if you put that against the percentage of my portfolio, you get the weighted beta. And again, just as a reminder, anything under 1 is less volatility than the S&P. And you can see most of the positions and stocks that I pick are pretty low beta. And so the total weighted beta for my entire portfolio is right here, 0.75. I think I just fell in love with my portfolio all over again. A low beta portfolio generating just around $95,000 a year at a 6% average yield with a ton of experiments and $100,000 in liquid cash for put options. It just doesn't get any better than this. Well, that's it for today. I hope you enjoyed this update. If you want a richer real-time experience with me, you can always follow me on Instagram, Twitter, or Threads. Or become part of the cult and send me your story along with a pic of you with something from my Etsy shop so I can answer you and cover it in an upcoming video. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want. No pressure. And as always, I encourage you to do your own research, then implement and learn by putting it into practice. As a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.